Welcome to the deep dive. When you're trying to understand how a company's really doing beyond the polished numbers.
Right, the prepared stuff.
Exactly. The real strategic thinking often comes out in the back and forth, that unscripted part.
The Q&A session with the analysts and investors, that's where you sometimes get the less guarded answers.
Precisely. So that's our mission today. We're skipping the official presentation, the headlines you've probably already seen.
Yep, straight to the interaction. We want to pull out the strategy, the risks they're focused on, the future plans, basically reading between the lines of that Q&A.
Okay, let's get into it. The first big theme that jumped out was around loan disposition. I mean, where are all these loans they're originating actually ending up?
It's this constant balancing act for them, isn't it? Keep loans on the books, that's the held for investment or HFI portfolio.
Or sell them off quickly into the marketplace.
Exactly. And they gave some pretty clear guidance there. The CFO confirmed the Q4 target for HFI is holding steady, around $500 million, roughly. They did add the usual caveat, that the final number depends on how the quarter actually shakes out.
Sure, always some wiggle room. But the really interesting part, I thought, was how they're selling the loans that they don't keep.
Oh, definite. The CEO emphasized it's all about best execution, finding the best price, basically.
And historically, that often meant selling to banks, right? That was the premium channel.
It was, but now there's this shift. They talked quite a bit about these new insurance-rated transactions.
And the economics there are surprisingly strong.
That's the key takeaway. The prices they're getting from insurance buyers are now approaching bank prices. That's a big deal. It opens up a whole new high-value channel for them.
Wait, hold on. If insurance prices are only approaching bank prices, why shift? Why not just maximize the bank channel? Is there something else going on?
Good question. It seems to be about the structure of those insurance deals.
Okay.
With these specific sales, they're generally not keeping the A-notes, the safest top slice of the loan pool.
I see. So it's more like a clean break.
Exactly. It functions more like a high-value whole loan sale. Frees up their capital faster, less complexity than if they kept a piece of the risk.
Got it. So it's not just price, it's also capital efficiency and simplicity.
Precisely. And they explicitly said this channel is a focus for development, and it's helping lift their overall loan sale prices.
So stepping back, what you're seeing is a pretty sophisticated way of managing their capital. They're tailoring the disposition based on the buyer.
Right. Banks, asset managers, these insurance funds. Each gets the structure that maximizes value for the company. It's an efficiency play, really.
Which makes perfect sense. And that focus on efficiency ties neatly into the next big topic from the Q&A, risk management and underwriting.
Yeah, analysts were definitely probing on that. With originations growing, the natural question is, are they having to lower their standards to compete?
Especially with some noise in the broader consumer finance space.
But the CEO's response was pretty emphatic. He talked about playing the long game. Meaning they're not chasing short-term volume spikes if it means making bad credit decisions. Profitability and sustainability seem to be the priority over just raw growth numbers.
And did they provide evidence for that? Is the underwriting actually still tight?
They insisted it is. The CEO used the phrase very, very restrictive, especially compared to pre-COVID levels.
Particularly in certain segments.
Yeah, he mentioned lower credit areas specifically. The growth they are seeing, he argued, comes from ramping up marketing from a lower base, not from opening the credit box wider.
Okay, so let's look at the specifics they shared on credit quality. What did that snapshot look like?
It looks, quite conservative. For instance, borrowers earning less than $50,000 a year. They make up only 5% of current originations.
Wow, that's a tiny slice at the lower end.
It really is. And remember those tighter rules around student loans they mentioned previously?
Yeah.
Seems to be paying off. Delinquency rates for that group are apparently down to just basis points and still shrinking.
And overall losses?
Charge-offs for the quarter were 2.9%, which, in this environment, suggests the loans they've booked recently are performing quite well.
That discipline must be helping them in the funding markets too, right? Especially with some competitors facing issues.
Absolutely. That was another key point. Despite some industry volatility, maybe even because of it, the CFO said investor demand for their assets, structured products, those rated deals remain strong. He actually framed the volatility as an advantage.
How so?
He said capital providers are getting more selective, further narrowing their selection of who they're working with. So a company with a strong track record and tight underwriting
Becomes more attractive. They stand out.
Exactly. Their discipline acts like a magnet for funding in uncertain times.
Okay, let's shift gears slightly and dive into some of the financial mechanics discussed. This is for those listeners who love the technical detail.
Like the accounting nuances.
There was this interesting point about loan reserves. They actually increased reserves this quarter, which seemed a bit odd given that they also said credit expectations were stable or even improving.
Yeah, that definitely caught analysts' attention. It looks counterintuitive on the surface.
So what was the explanation?
The CFO gave two main reasons. First, it was partly just a comparison issue. Q2, the previous quarter, had benefited from a one-time positive adjustment.
Like a tailwind in Q2 that wasn't there in Q3.
Pretty much. About $11 million positive impact from a re-estimation they did back then. Q3 just didn't have that, making the quarter-over-quarter increase look bigger.
Okay, that explains the comparison. But
Yeah.
was there an underlying reason for reserves to go up at all?
Yes, and this ties directly into their growth strategy and accounting rules, specifically CECL.
Right, CECL, current expected credit loss. Remind us quickly how that works.
Sure. Basically, CECL forces companies to estimate and book the entire expected lifetime loss of a loan the moment they originate it. You have to reserve for it upfront.
So it's like a big upfront charge, even if the loan performs perfectly for years.
Exactly. And the longer the expected life of the loan, generally the higher that upfront CECL charge is.
Okay, so how does that connect to the reserve increase this quarter?
Well, they mentioned growth in longer duration assets, specifically their purchase finance business.
Yeah.
These loans naturally have longer terms.
So as they grow that part of the business, even with good credit quality.
The accounting rules require a bigger upfront reserve build. The key strategic point the CFO made was that they're happy to take that upfront CECL hit because those longer duration assets have fantastic economics on balance sheet.
Got it. So the reserve increase is actually a sign of them investing in what they see as high-value, longer-term, profitable growth.
Precisely. It's the cost of growing in that specific attractive area.
Let's pivot now to growth efficiency. This was another really interesting thread in the Q&A.
The marketing engine.
Yeah. Despite ramping up marketing spend quite a bit compared to last year, repeat business is still holding strong. What was the number?
Around 50%. Roughly half their loan volume comes from existing customers coming back.
That feels incredibly important.
Oh, it's fundamental to their model. The CEO really hammered this point home, the LTV, the lifetime value flywheel.
Explain that a bit more.
Okay, so repeat customers are, first, much cheaper to acquire. You don't need as much marketing spend to bring them back.
Makes sense.
Second, they tend to have lower credit losses. They're known quantities. And third, if a customer comes back once, the CEO said they're likely to return maybe 3 or 4 times over their life cycle.
Wow, so the total value generated from that customer just keeps multiplying.
Exactly, which means the total profit from that customer relationship becomes much, much higher. And that justifies spending a bit more, the higher marginal cost, to acquire new customers in the first place.
Because you know a good chunk of those new customers will eventually become highly profitable repeat customers.
That's the flywheel. It makes the marketing spend very efficient over the long run.
Speaking of efficiency and resources, let's touch on capital. They have a very healthy CET1 ratio. That's the core capital measure sitting at 18%.
Yeah, very strong.
An analyst asks, is that maybe too much capital? Is it just sitting there? What's the plan for it?
The CFO was crystal clear on this. Priority number 1 is using that capital for growing the balance sheet as we ramp up originations.
So funding that HFI loan growth we talked about earlier?
Correctly. That's the primary use case. Things like buybacks or dividends, those are secondary. They'd only consider those if they have excess capital after funding the balance sheet growth they want.
Growth first. Okay, let's move towards the future now. Product roadmap, brand stuff. First, a quick clarification on those investor programs. BlackRock, the insurance deals.
Right.
Can regular retail investors get in on those directly, like buy pieces of those loans themselves?
Management clarified that. No, these are not direct-to-consumer sales.
So how does private money get in?
It flows through funds, vehicles managed by wealth managers, RIAs, registered investment advisors, that kind of structure.
And why not sell directly to retail?
It sounds like it comes down to regulation and data. To sell directly like that, the loans would likely need to be classified as securities.
Which means more regulatory hurdles.
Exactly. More overhead, and critically, it would likely force them to disclose a lot more proprietary data about their loans and underwriting stuff they consider a competitive advantage and want to keep private.
Okay, so the current institutional focus maintains that edge. Looking ahead more broadly, What did they highlight from their 2025 product launches?
They called out Level Up Checking, Level Up Savings, and Debt IQ as key successes this year.
So expanding beyond just lending into broader banking and financial wellness tools.
Seems like it.
Yeah.
Deepening the customer relationship, giving people more reasons to stick around and become those valuable repeat customers we talked about. And the CEO definitely signaled there's absolutely more to come on the product front.
But the really big piece of forward-looking news was the rebrand.
Yeah, that's a major initiative. They confirmed they're in the final stages of R&D for a completely new brand identity.
And this isn't just cosmetic, right? There's a deeper strategy.
Apparently so. The language they used was interesting. The goal is to give the company a broader permission set with our customer base.
Broader permission set. What does that imply?
It strongly suggests they want to move into new areas, new types of financial services, perhaps, that maybe their current brand doesn't quite fit or give them credibility for. It's about creating new opportunities.
Interesting. Any hints on timing?
They said the transition will be pretty deliberate. They don't want to lose the positive equity they've built in the current brand.
Makes sense.
The target launch is currently slated for middle-ish of next year, so mid-2026.
Okay, so wrapping this up, this deep dive purely into the Q&A really paints a picture of a company focused, almost obsessively, on high-quality, profitable growth.
Yeah, not just growth for growth's sake. We saw that sophistication in how they sell assets, chasing the best execution, even if it means building out new channels like insurance.
We saw the underwriting discipline, that tiny 5% exposure to lower-income borrowers, the shrinking student loan delinquencies.
And that incredibly powerful marketing engine, fueled by 50% repeat customer volume and the LTV flywheel concept. It all ties together.
It really underscores that lasting success, especially in finance, isn't just about getting bigger. It's about managing capital smartly, controlling risk rigorously.
Particularly when the market's a bit choppy and funding sources are getting pickier, that discipline becomes a real differentiator.
So let's leave our listeners with that provocative thought, stemming directly from the Q&A. The CEO said the new brand, coming in 2026, is designed to give them that broader permission set.
Right. What doors does that open?
Exactly. What new areas, what new asset classes or services, maybe mortgages, maybe wealth management, maybe small business lending, who knows? What do you think they're planning to launch in 2026 that the current brand doesn't quite give them the permission to tackle effectively?
Something to think about. What does that broader permission set really unlock for them strategically? Thanks for joining us on the